Spoiler alert, mortgage rates aren't just based on the Fed rate. Let's talk about what really moves the needle. Today we're here with Nicole Rueth, the Rueth team at Movement Mortgage. Thanks so much for being here, Nicole.
My God, my pleasure. My pleasure.
So we're thinking that today we will talk about mortgage rates and I keep hearing in the news that they've hit a low in the past year. So what exactly does that mean? Are we, because they were close to 7 for a while.
Yes.
And then it seemed like they were maybe around 6.75. So are they around like 6.5 now?
Actually lower. So we're seeing 6.375. So we saw a massive drop in interest rates this past week. So when you're talking about what moves the needle, there's been a lot of conversation around interest rates right now. It's a hot topic for sure.
Yeah. And because this moves so much on a daily basis.
It does.
I just want to take a minute and say that we're recording this on Saturday, September 6th. So for anybody watching the video later, if they're like trying to figure out when was this, when were they talking about this, they'll know. So a lot of what's been in the news lately, I feel, and I don't watch a lot of news, is stuff about the Fed rate or the Fed cutting rates in September. And at this point, there's like 100% chance that they're cutting it. And so can you talk a little bit about how and why that piece of news right there is related to where the rates are right now? Because most people are going to hear the news about the Fed cutting the rate and they're going to go, well, when the Fed cuts the rate in September, that's when the rates will come down. But can you kind of explain why the rates are down right now, in part because of that?
Yes. And I love that question because so many people want to wait until later in September or October to even start looking at buying or purchasing, thinking that we're going to have lower rates. And there's a lot of conversation with, now that the Fed has started acknowledging that they need to start cutting the Fed rate, then at what pace will they cut the Fed rate? How much will they cut the Fed rate? All of that conversation is going into, well, then I want to get a better interest rate. I'm going to buy now so that I can refinance, or I'm going to wait and buy in the spring when the rates are lower. That's the idea. Interestingly enough, the Fed rate and the 30-year fixed rate, they're cousins. They move on the same economy, but they don't necessarily move together. So the Fed rate controls short-term rates. Think of your HELOC rates. Your HELOC rates are point for point exactly moving with the Fed rate. So if the Fed rate moves, so goes the prime rate. HELOCs are based on the prime rate, or home equity lines of credit. Credit card rates, car loan interest rates, short-term personal loan rates. What moves the 30-year fixed mortgage rates is our long-term bonds. Long-term treasury bonds are really just a stable investing instrument that investors put their money for long-term returns. Those long-term returns are typically tied to our long-term returns required by investors of mortgage-backed securities. So all of this is just simply things that investors can invest their money in, and those investors move markets based on, and we see that every day. We see that, say, cryptocurrency. It's so easy to talk about cryptocurrency because it's so volatile. And it's so volatile based on any one singular headline or move. Say the administration, Trump, we know he started his cryptocurrency. And so there's all of this rally and conversation around it. And so then all of a sudden you'll see the value of cryptocurrency going up, or you'll see some regulation coming out or some conversation, and you'll see the value of cryptocurrency going down. That same theory applies for mortgage rates. It's just kind of behind the scenes because it's investors of long-term treasury yields. And those investors are making moves and buying or selling bonds based on economic data. So it's actually, what we're seeing is, it's what's the inflation data? What's the CPI, or the Consumer Price Index report, the kind of inflation you and I feel when we go to the grocery store? What's the PCE? That's a Fed's preferred measure of inflation. That's more of a medical. So when we think about our deductible, that's in CPI. When we talk about what are medical carriers paying, that's PCE. So it's a larger scope or view of the economy. That's inflation. So those reports move the markets. They move where investors put their money. and what investors are betting on will happen in the future. Then you also have labor reports like the BLS jobs report that just happened. So that will move the markets if it comes in lower than expected or higher than expected. So labor economics, inflation economics, GDP, how fast the economy is growing. So all of that is determining what investors believe. They're like rolling a dice. Based on this data, what do I believe the next step will be? And that's how I'm going to move my money. I'm going to move it into bonds or I'm going to move it into stocks. And that's why our 30-year fixed mortgage rates move. Now, the Fed, they have to take a longer view. And so they're determining and they're moving the lever on monetary policy. How easy is it to borrow money, or how stringent is it? Is it more expensive? And so you're going to pull back on borrowing money to put more liquidity out in the market? Or are you going to make liquidity easier to get access to by lowering the Fed funds rate? So they're playing this lever game of bringing more money to the market or pulling it back. And they're doing it based on how hot the market is. If we have a strong economy, you're going to see that in how they move the lever for their monetary policy. You'll also see that in interest rates. So it's interesting because all of this sounds somewhat complicated and convoluted, and I get that. But ultimately, it's investors. So investors, to answer your question, investors have already... There's 100% probability that the Fed is going to move the Fed rate. They're going to loosen monetary policy and make borrowing money cheaper. We've already decided that they're going to do it. If they don't do it, that's going to shock the market. But if they do it, then they did what we expected them to do. So because the investors have 100% probability, investors have put their chips on the table based on how they thought the results were going to turn out. Our interest rates are set on that happening. If the Fed does a quarter point cut in September, we will see absolutely no move in our 30-year fix. We already saw a drop, and we saw the biggest drop because of the jobs report. Nothing to do even with the Fed rate.
And so really, with this drop that we're looking at right now,
Yep.
it seems like, I just want to point this out to people because we do not recommend that you try to time your buy with the market or with interest rates. Yeah, we don't recommend that at all, because what I'm going to say right now is that I saw you put this out earlier. Now is the time for the people who already bought and they maybe are at a 7% interest rate from a few months ago.
Yeah.
Guess what? They can refi now.
Yes.
And I think your team offers a free refi within, like, is it 12 months or something like that?
We don't even have a time. I was timing it to begin with, and then this has just been so much longer than we thought it was going to be with the higher interest rates.
Yes.
So I have told my team, when interest rates drop and the people that purchased with us since the fall of 2022, we're going to honor that.
Oh, that's so sweet. Yeah. So listen closely. You don't time your buy with the interest rates. You get into your house that you want, that you can get into now, so you can start appreciating and building equity. And then you watch the interest rates so you can refi. There's probably a couple of situations in which there are restrictions on refis, like, isn't a VA loan, don't you have to wait 6 months or something before? Can you just kind of go through some refi stuff for us?
So VA will require you to wait 6 months. So will FHA.
Okay.
So if you want to do an IRRRL, is what they call the VA streamline refinance, the interest rate reduction loan. And then if you want to do an FHA streamline refinance, that's what they call it, you have to wait the 6 months. And so they'll tell you exactly what day, and the lender can determine based on how many payments or how many days into the loan you are when you can exactly refinance. And they both have somewhat restrictions on it has to be a benefit to the borrower. So you have to fill out a worksheet to show that we're giving the borrower enough benefit so that they can't be taken advantage of and just refinanced a bunch of times. The conventional loan is much less restrictive. You can refinance that pretty much anytime you want. You could literally purchase it and you could refinance it the very next month. I will tell you that the lender who did the loan, we are paid a small commission for every single loan that we do, and we're paid that based on the servicing dollars. There's really no money in originating a loan. The money is in servicing the loan. It's the long-term hold of the loan.
Oh.
So the servicer who eventually holds that loan that you write your mortgage payments to every month, they pay the company, and that company pays you a commission based on the value of that servicing. So if you refinance within 6 months, regretfully, the lender that did the loan will have to pay back the commissions that they earned,
Oh, sad.
which is super interesting. Yep. So there's a pullback of those commissions for 6 months. So a lot of times the lenders will say that you can't refinance for, 6 months. Regretfully, that's not necessarily true, but it does impact the loan officer.
Yeah.
Yep.
Yeah. So that's definitely something to keep in mind. But
Yeah.
my guess is the numbers of people that are inside that 6 months are low compared to how
Very
many
few.
people now have a 7%
Yes.
interest rate and could take advantage of refi.
And if they did it within the last 6 months, they might have a half a point benefit, and it might not be worth it doing it for half a point. But if you did it a year ago or even within the last couple of years, and you have a 6.99 all the way up to, we're seeing some people at 8s and 8.25, depending on their credit score.
Yes.
If they've been working on their credit score, if they've been improving that, and the rates have gone down, now is definitely the time to look at this window.
I'm glad that you said that, because I was just going to bring that up, that if you had a much better credit score now than you did when you took out the loan at 7 or almost 8%, that could also be help you lower your monthly payment quite a bit.
Yeah.
So what are the breaks in the, I know this is going slightly off topic, but like how much of a credit score difference would somebody want to be looking at, like 50 points or 100 to really make a big difference in their interest rate? Or is it just every 20?
It's every 20. It can move the needle. It could drop you another 1/8 of a percentage. And maybe it's every 40. It depends on so there's a pricing model where it's behind the interest rates. And a lot of times you can kind of inch into something with other things. Maybe you've got a lower debt to income ratio that can help with mortgage insurance, and definitely a little bit with your regular interest rate, certainly your credit score, how much equity you've got, that can add in. So maybe you've got 25% or 30% equity in the home because you've had it for a couple of years. Maybe you did get a little bit of the run up, but maybe not all of it. It'd be hard to say because most of the interest rates were at their height when the appreciation stopped. So all of that we look at, though, and maybe you have more money to put down. Maybe you sold a house in the meantime. So there's so many factors that we can look at.
Always.
Yeah. So I would say it's definitely, if you have anything over really probably 6.99 and up, it's worth making a call.
Taking a look at it.
Absolutely.
Yeah.
It doesn't cost you anything.
Well, I love this. So today we talked about what really moves the needle on interest rates. And that conversation was sparked by the fact that we have a low in interest rates right now. It's been over a year since we've seen interest rates this low, and they're down at 6.3, you said?
Yes.
6.3. So if you're shopping right now, awesome. And if you recently purchased or you purchased in the last few years and your interest rate is maybe 7 or 8, now's a great time to make a phone call and look at possibly refinancing for a lower payment. And that is the reason why you should definitely just find your house and get into it, and then look at refinancing later, because then you're taking advantage of the appreciation and building equity in the meantime while you wait for interest rates to come down, rather than losing out on all of that equity and appreciation while you wait for rates to come down.
Agreed.
So, yeah. So thanks for being here, Nicole.
Yes, this is fun.
Yeah.
Thank you.
If you like this content and want to support the channel, don't forget to hit the like, subscribe, and alert bells before you go.